provide some intuition for the analytics behind this result. To do so, it's useful to think in terms of a monopolist problem, the firm selling debt to its investors. In this context, we'll see that the results regarding the share price is closely related to the Coase conjecture from durable goods monopoly. The demand curve is the price investors will pay for the debt, given the total face value of debt outstanding. It's equal to the present value of the expected coupons investors will receive, and it naturally declines with leverage as default risk increases. The firm's marginal cost for debt is below this price, as shareholders discount the after-tax coupons at a higher rate that does not include the liquidity premium enjoyed by debt. In an MM world, these two curves would coincide and there'd be no incentive to issue. But with tax shields or a moneyness premium for debt, which lowers the cost of capital, there is a gap and thus gains from trade. Of course, the optimal issuance in the monopoly problem is to set marginal cost equal to marginal revenue. So let's add the marginal revenue curve. And so profits are maximized by issuing an amount delta that is equal to the difference between price and marginal cost divided by the marginal price impact. Of course, once the monopolist has issued this amount, there's a temptation to satisfy the residual demand and issue more, which is simply the leverage ratchet effect we described earlier. Okay, so what happens as we increase the frequency of trade? For a short time interval, the difference between price and marginal cost is simply the tax savings and liquidity premium that will accrue before the next opportunity to trade. So when the trading frequency increases, this gap is of order dt. So as long as the price sensitivity of debt is positive, the optimal issuance is also of order dt. That is, the limit issuance policy is a smooth trading policy. What about the gain from trade? As you can see, the gain is proportional to delta squared. Right? This is equal to the issuance amount delta times the gap between price and marginal revenue. This gain, proportional to delta squared, is therefore of order dt squared. Thus, the cumulative gain from trade collapses to zero as the trade interval shrinks. Again, this result is analogous to the Coase conjecture from durable goods monopoly. By competing with itself, the monopolist dissipates its monopoly rents. The key takeaways, again, which build on my work with Gigot and Fabrice, are first that with continuous trade, the firm will issue debt gradually at a rate that balances the funding cost advantages of debt with its price sensitivity. As a result, leverage adjusts slowly over time, with new issuance offset by debt maturity and asset growth, and the speed of adjustment towards the target dependent on the debt maturity. And finally, as a result of non-exclusivity, the potential gains from trade due to the funding advantages of debt are fully dissipated through an increase in default costs and investment distortions. Okay, so with that background, now let's add collateral to this setting.